Hey, how's it going, Options Alerts members? So, wanted to make a video out to you to answer a few questions and just to kind of explain again how everything works. So obviously, we're trading in really volatile markets. I mean, just look at the right. Look at the Qs, right? You start with the Qs, and you're looking at this here. Markets were down 15% for the year, right? Then we bounced 5%. Then markets down 20% for the year. Then you go all the way back up, only down maybe 5 or 10%, and now we're back down, making a new low again. S&P, same thing. For the longest time, it tried to stay pretty strong, stronger than the Qs, but now look at it, weakening again. Markets drop down 15, 20%, go right back up almost even for the year, and then boom, shilling, right back down, rug pull, right? And that's because energy, which was strong, keeping the spiders up, has also remained steady, but not really going higher again. So that's putting downward pressure on the markets. But that being said, the goal is not to do a market review. The goal is kind of explain a little bit about option service and how it's transitioning. So obviously, when we were in a low VIX environment, right, low volatility environment, buying at the money, out of the money options was a really good strategy, and we did really well, right? We were up a good amount for the year, and then we transitioned as the volatility starts to ramp up, going more expensive options, going more in the money, and typically losing about the same if it loses. But it's been traded with a much bigger position size. And that's kind of why, if you guys are looking at the tracking sheet, you must have seen fluctuations in the P&L. But you guys shouldn't have taken that fluctuation, because the fluctuation is because when I started Options Alerts, right, the spreadsheet beginning of this year, the risk was from anywhere from $1,000 to $3,000 worth of options is what I was buying, right? So the return was really, really good. I was up, I think, close to $50,000, $60,000 at one point of the year. Now, obviously, we've given a lot of it back, but we actually have not. The reason for that is we had a lot of winners, right? 50, 60,000, but that was on maybe a $2,000, $3,000 position, right? So now, even though, yes, our P&L might have pulled back, but that's not the true representation of the trading. And the reason for that is because the risk has gone up. The positions that were sized from $1,000 to $3,000 are now being sized $10,000 to $11,000. So naturally, the loss is going to be bigger. That's just a personal decision that I made, is to raise my risk on these trades, right? So that's just my personal opinion. But if you kept your risk relatively the same, then you shouldn't obviously have taken, anything close to what I took in terms of losses. So I want you to understand that, because some people might look at it and say, oh, wow, you're 50, 60,000, now you're up only like 10, 15 or 20. That's a big wipe away of gain. In a dollar amount, yes, but in our unit sense, not really. Because think about it. If you're risking $3,000 and you end up making, let's say, I don't know, 30,000, right? The risk units is very different than, let's say, you risk $10,000 a trade and you lose 30,000. Now you only lost 3R, right? Whereas in the other one, you gain, a lot of Rs. So that's kind of how I want you guys to think about it. Now, what to expect going forward? So what to expect going forward is we're continuing to keep doing the amount of trades, obviously, that we're doing. And we're going to keep doing the in-the-money trades as long as the volatility remains high. When the volatility starts to settle down, or if it turns around and comes back lower, we can potentially switch back to the old strategy. But I like this strategy. Even though the dollar-wise, the gains have been lower, in percentage terms, longer term, I think this will be a much better strategy as well. We're just trading, obviously, in a crazy environment where things are getting shellacked all over the place. So that naturally you're going to get chopped out as a trader. I mean, just think about it. You're an investor. You put your money in the market, you're down 20, 25% for the year, right? So by that measure, if you compare being down 20-something% and being up 20-something%, that's a big difference, right? So we're overall doing really well, and that's kind of how I want you guys to judge yourself. The benchmark is, how did you do if you just put your money in the markets, right? Typical return on any other investment strategy would be 8 to 12%, right? So if you're getting, at least 2 times that, it's worth it, is my opinion, right? So that's kind of how you got to think about it. The other thing I was also thinking was, I know a lot of you guys have smaller accounts, so maybe we have 2 separate spreadsheets, and I call both like I used to call before, and the new ones. It's just a lot of work, so I'm going to debate about that. But I'm also waiting for the volatility to settle down. So if volatility settles down, then we might add both strategies as separate strategies. That could be a potential option in the future. So I want you guys to send me your questions. I want you guys to send me your feedback. But again, the best way to use this service is this: pick a dollar amount, right? That's kind of, in my opinion, the best way to do it, right? Pick a dollar amount that works for you. Okay. So it was what is it? So right now I'm sizing positions to $10,000. Okay, and my loser on a $10,000 position could be anywhere from $1,000 to maybe even $5,000 sometimes if we get caught up in a bad trade. So that's kind of the risk. So you got to assume that if you're sizing it as I'm sizing it, right? If you're sizing the position, let's say, hey, Anmol's buying 10 contracts, I'll buy 5, right? You're half in the position size. That's fine too. But again, are you okay with taking that risk? Probably not. So a better approach, in my opinion, than doing a fixed contract size with these type of trades would be to pick a number. Hey, I'm going to do a quarter of Anmol's size. But then that's what you do on every single trade, a quarter of Anmol's size, right? Or you do a third of my size, or you half, whatever your risk management is. But you have to be okay with that risk. Please don't take a trade and say, oh, I took this trade and it's down like 50%. Oh, what do I do? That's a pretty big loss. Well, you got into the trade knowing the risk, right? So you have to know the risk going into the trade. So expect whatever I'm buying the option for, expect like a max loss of potentially, 50% of the value of the option. But typically, majority of them over a long enough time frame are going to be in the 30% loss area. So you got to be okay with losing minimum of 30% off that option price or maximum of 50%. So that's kind of how I want you to calculate. But I want you to keep your position size relatively the same dollar amount. So eventually, at the end of the period of trades, the percentages take care of itself. So that's how I'm doing it, right? That's how I think is the best way to do it. But again, do your own due diligence and things of that nature. Spreadsheet's already there. I know it's not been easy. I know the market environment has been really tricky, but we can't change it. Look at the market, still going down as I watch, just not able to bounce. So there's not much you can do in this market. We got to ride this wave out, and sooner or later the markets will strengthen, and then we'll look for that. Like example, IYR. This one I should have probably be out on Friday. Unfortunately, I wasn't at my desk. I wasn't looking at it, and now look at this IYR back down to 99. So definitely we have to cut this position soon, and I was going to cut it, but unfortunately I was looking to see if it can bounce up a little bit and we can exit on a bounce. So we'll see. But IYR, definitely I want to exit this. So tomorrow, if we get a bounce, I'm probably going to look to exit this trade because it's not looking that great. But we got 4 days left till the expiration. Might as well see what happens. But right now the markets are looking really weak. There is no support. So we have to be really, really mindful that we're not trading in normal environments. This is a normal environment, right? That's when you make a lot of money as a potential options trader, right? Especially as a trend trader. You make a lot of money in that environment. But, sooner or later market will find a trend. So we'll have to wait for that. But again, I just wanted to make a quick video for you to make you aware, because you're going to see as the trades and the recent losses get added on the spreadsheet, you will see the numbers drop drastically, right? From us being up 30, 40, 50,000 for the year, go down to around the 10 range. But I want you to know that that's not exactly all the number of trades we lost. It's just that I've been trading much, much bigger, position sizes. So that's kind of the reflection. So just wanted to make you aware of that. But again, we're going to keep doing things. There's no change in the strategy right now because, again, you don't judge a strategy based on a few weeks of data. That's the wrong thing to do. So we're going to continue to trade the strategy and see what results it might bring down the line. But again, please position size correctly. That's super important, because if you don't position size correctly, what will end up happening is at the end of the year, you look at the spreadsheet. I'm like, oh, look at options alerts. It's up nicely. But you look at your own account and you're like, I don't know why I'm not up that much. And that's because of incorrect position sizing. So you have to be really mindful of that. So take care, everybody. I'll see you guys in the next video.